Hello, beautiful people, and welcome to another brand new edition of the ITU Forex Class. In this week's edition of the class, we're actually going to be talking about the dollar index and how to use the dollar index to find low risk, high probability trade setups in the Forex markets. Okay, so before we dive into the class proper without wasting any more of your precious time, we first need to understand exactly what the dollar index is. Okay, so as you've heard me say, the dollar index is kind of like a basket of currencies, okay, which are weighted against the dollar, the strength of the dollar against the basket of currencies. That's what I meant to say, okay? So let me show you an example. If you take a look at this market watch window, you'll notice that I've got a ton of currency pairs here and other tradable instruments. But what I want you to focus your attention on is the majors, which are simply currency pairs which have the dollar as either the base currency or the quote currency. If you've been trading for any length of time, I know you're well aware about what is referred to as the base currency and the quote currency. So, for example, in this particular currency, which is the GBP JPY, the British pound, since it comes first, the GBP from the name obviously, since it comes first in the currency pair, the GBP, the British pound, is referred to as the base currency, while the second currency in the currency pair, which in this case is the JPY, is referred to as either the quote currency or the counter currency. Okay, so this currency actually, you see, it has nothing to do with the United States dollar. So this is nothing. This has nothing to do with the dollar index. But when you take a look at currencies like the GBP USD, you can see obviously the USD is the base currency, is the quote currency in this particular currency pair. And currencies like the Euro USD, again, since the dollar comes as the second currency in this currency pair, it's still the quote currency or the counter currency in this pair. Then we have currency pairs like the USD CAD, which have the United States dollar as the base currency. It comes first, and the Canadian dollar comes second. So what does this have to do with anything? Well, the way the dollar index is measured is these currency pairs are going to be taken, okay, and then they are going to be put in a basket. All of this, you don't need to do it on your own, you know, crunching the numbers and all of that. I'm going to show you how to see this thing, just like you can see a normal chart, a regular chart like this, and just how to decode it. But I kind of want you to understand the logic behind what it represents, okay? So the dollar index is kind of like taking all of these currency pairs that have the United States dollar as either the base currency or the quote currency in the pair, and then it's weighting them in one instrument to actually show the strength of the dollar or its weakness on a plain chart. Okay, so as you can see, obviously now we have the British pound against the Japanese yen as the chart which you are seeing, but this is not what we want to actually study. Okay, so to open the chart of the dollar index, what you need to do is to quickly type, if you're using TradingView, obviously you can get a free subscription of TradingView, just a free account. Okay, you don't need to subscribe, and you'd still get access to this data. Okay, so you can see after typing on this symbol search, I typed DXY, which is the dollar index. You can see the United States dollar currency index. Okay, so you can click on it and it's going to open the charts for you. And just like any regular tradable instrument, which you can trade within the markets, you can see this is showing you the price action on this particular pair. You can go all the way to the monthly, or you can go all the way down to the weekly, or even the daily, or whatever you want to analyze, okay? But like I told you, I want to show you how to use it as a tool to help you gauge exactly what to do, how to trade. Okay, so for example, if we're using market structure, if you've been coming to the IT Forex classes, I'm pretty sure that by now, market structure is nothing new to you. Okay, so for the benefit of those who are just joining us, market structure is basically how price moves in the financial markets. Okay, so if we have an instrument in an uptrend, price is not going to go up in a straight line without pulling back or making retracements. The same thing goes for when price is in a downtrend. No matter how strong the downtrending move is, price is not going to go down in a straight line. What you're usually going to find is that price is going to go up a little bit if it's in an uptrend, and then it will pull back, retrace its step, But that retracement will not be, will not go all the way down to where it started from. And then it's going to go up to break the previous high, which it found resistance at. And then it's going to pull back a little bit again. And the pullback is not going to be as low as the original pullback where it started from. It's going to continue doing this. Higher highs, higher lows, higher highs and higher lows. It's going to continue with this formation up until the time when the trend weakens and price either starts consolidating, ranging, or we have a reversal in price action altogether. So you can see from this particular chart, this is the daily chart of the dollar index. Okay, so you can see that price was way around here, around the end of 2000 and 2004 November. From November 2004 up until the early months of 2005, you can see that for the daily chart of the dollar index, its price was actually moving in an uptrend. It was forming higher highs and higher lows. But then somewhere along the line, price found it difficult to break above the previous high, which it found resistance at, and so it couldn't even test it. Okay, this was how weak the price action was. Then we had the formation of this long wick candlesticks, this bearish engulfing candlesticks, and all of a sudden we went from forming the market structure of a downtrending market, of an uptrending market, which is the formation of higher highs and higher lows, to now price forming lower lows and lower highs. So we've shifted from an uptrending market to a downtrending market on this particular pair. We can see this at a glance by using market structure. But assuming you don't know how to use market structure, again, you can use tools like moving averages. It's as simple as that, okay? So some traders just use it in the way that if price breaks above the moving average, this is obviously a 60-period simple moving average on my chart, applied to prices high, low, and close, okay? So when the way some traders, just for simplicity's sake, the way some traders use it to identify the direction of the trend is when the price of any instrument, not just the dollar index, which we're using as an example here, but when the price of any instrument crosses above the moving averages and it closes above that, that's considered to be a bullish sign, okay? So that particular instrument, for as long as its price is going to remain above the moving averages, will be considered to be in an uptrend. While when price crosses and closes below the moving average, in this case, to the downside, this would signify to some traders that, okay, we're in a downtrending market, okay? So for this particular example, you can see that we used market structure for the first example, for the first instance, and you can see we can also see the same thing with price action here. For what do you call it? For the crossover, the moving average crossover method. And in this case, price has crossed above here and it was up. But when it crossed below, you can see we had the move, this downtrending move. Okay, so now that we've talked about understanding the direction of the trend, how can we actually use the dollar index to find low risk high probability trade opportunities? How can we do that? Now, what I want you to consider is, if you pay close attention to this chart that we have here, okay, you can see that in and around the period of around, let's say, somewhere around February of this year, okay, you can see that the dollar index went from forming the market structure of an uptrending market, higher highs and higher lows, which is characterized by the formation of higher highs and higher lows, to now finding it difficult to break above the highs and completely turning around to start forming the structure of a downtrending market, which is lower lows and lower highs. So what does this mean? This is simply telling us that we went from having a very strong dollar in the market to all of a sudden price now, the strength of the United States dollar tumbling down. So when the dollar is tumbling down, what do we expect to see on currency pairs like the Euro USD or the Euro JPY, or the USD JPY, or all of those pairs, okay? Or any pair that has the United States dollar as either the quote currency or the base currency is actually going to be affected by a strengthening dollar in the market. How is that going to happen, you ask? Well, that's going to happen in the way that if you have the Euro USD, for example, and the dollar is weakening, then in that case, the Euro USD chart is going to be going up. Why? Because if the dollar is getting weak, then the euro is actually going to be getting strong. And so as a result of this, you're going to need much more euros to you're going to need much more euros to exchange for the United States dollar. Let's quickly go to the euro chart to look at an example. Okay, so starting from February here. Okay, this is the daily time frame. Okay, let me pick a vertical line just to place it here to make it easy for us to identify. So starting from just around February of 2025. Okay, let's just go. Let's say the 13th of February. Now let's go to the chart of the Euro USD, for example. Here, okay, the daily chart. You see, this was exactly what I was telling you. Okay, so when you look at the daily chart here of the Euro USD, when we go back to around February, which is the time which we saw that switch in the dollar index from forming a downtrending market from forming an uptrending move on the dollar index, which is telling us that the dollar is strengthening, to switching to a downtrending market, which is telling us that across the board, the dollar is weakening. And so just have this at the back of your mind. When any currency pair has the dollar as the second currency, so examples of this would be the Euro USD, the GBP USD, any currency pair that the USD is the second currency in that pair, then if the dollar is strengthening, that pair is actually going to be going down. But if the dollar is weakening, that pair is going to be going up. So you can see February that we used as an example, let's say we said around February 10th or so, the switch in the trend on the daily time frame of the DXY, it actually occurred. You can see that even the same thing is visible on the chart of the Euro USD. So once you see that the dollar index, for example, the market structure on the dollar index or the moving average, whatever one of the methods you use to identify the direction of the trend, once you see that the dollar index is also weakening, or it's whatever the case might be, this is giving you, let's say you already are trading based on on market structure on the Euro USD. So let's say you've been seeing that the Euro USD has been forming lower lows, lower highs, lower lows, lower highs, lower lows, and lower highs. But then all of a sudden, after forming this low, when the Euro came back to try to break below this low, it failed to do so. In fact, it couldn't test it all the way down. And so when it came here, it bounced away from it. And then when it came here, it couldn't break it initially, but it gathered enough momentum and eventually it broke above this level. Okay? So, assuming you saw this, okay, or you're just using moving averages to see that, okay, this price of the Euro USD, it went from being below the moving average to now crossing above the moving average. So once you saw something like this and the market structure has shifted and you've also seen a confirmation of a reversal of the trend on the USD, on the DXY. This is another confirmation telling you that, okay, it looks like every currency pair that has the dollar as the quote currency is likely going to start going up. Why? Because the dollar index is showing us that there's a weakening of the strength of the dollar across the board in the markets. So once you've seen this, remember it was around February that we saw this switch on the DXY, you could have taken a trade on the Euro USD because you are banking on the dollar index being weak, and so the Euro USD is going to be going up, and you can see just how much it went. So imagine getting in when the market structure just shifted, and you identified this on both the dollar index chart and the Euro USD chart, and you banked on this trade. And this is just one currency pair, by the way. Okay, this is just the currency pair of the Euro USD. And if you've been following me close along, you know that this same thing we would have been expecting this same thing to happen on the charts of currency pairs like the GBP USD. Why? Because the GBP USD also has the dollar as the quote currency. So once we saw that there was a weakness or a change in market structure on the DXY chart, then we would be expecting also that since the weakness on the DXY chart, which is telling us that the dollar is weakening, once we saw also a shift in the market structure of the GBP USD currency pair, we would have also taken another trade here, banking on the fact that since the DXY is weakening, every currency pair that has the United States dollar as the quote currency is actually going to be going up. And this is exactly what we see here. Again, let's check another chart. AUD USD. Remember? You see? even though it's not been as spectacular as the other pairs, because obviously the volatility for the GBP USD and the Euro USD is going to be much more than that of the AUD USD, but you can see that still the AUD USD is not in a downtrend. If anything, we would say that it was moving in a downtrend and then it switched from moving in a downtrend to now slightly moving in an uptrend, not making a dramatic turn, but still it's not in a downtrend. So the weakness in the United States dollar is shown on this chart as the AUD, the Australian dollar, is increasing in value against it. Okay, so when we go back to the chart of the dollar index, which in this case, remember I told you for you to do that, you just need to type DXY. You can see that this is very, very clear for us to see, because on the daily time frame, you can see that before this, the dollar was actually very, very strong, and it reflected on the charts of currency pairs like the Euro USD or the USD, GBP USD, as the chart was going down. But once we had the switch in the market structure on this particular dollar index, which is showing us the strength of the dollar across the board, across a basket of currencies that is being traded on, you can see that once that switch happened here, it also reflected in the other currencies. So in a nutshell, what does this mean? What this simply means is that you can use the dollar index as an added confirmation for when you identify trade setups which involve the United States dollar. So, for example, let's look at another example of a currency pair like the USD CAD. You see, we talked about the Euro USD, which is a currency pair where the euro currency comes first. That's the base currency, and the USD comes second. That's the quote currency. We talked about the GBP USD, which is also a currency pair where the United States dollar actually comes as a quote currency, not the base currency. Okay, but how does this affect currency pairs like the USD CAD or the USD JPY or the USD CHF, where the United States dollar comes first and the other currency pairs and the other currencies like the Canadian dollar, the Japanese yen, or the Swiss franc comes second? Again, it's the same thing. Just remember this: when the dollar is strong, for currency pairs like the Euro USD, GBP USD, and all of that, the currency pair is actually going to be going down. Okay, when the dollar is strong. But when the dollar is weak, for currency pairs like the GBP USD, Euro USD, and whatnot, the currency pair is actually going to be going up. And remember, for the DXY, if the dollar is strong, it is going to be going up because it's not against any currency pair. It's just showing us the strength of the dollar across a basket of currencies. And if the dollar is weak, it's just going to be going down. So what does this have to do with anything? Since we understand that for currency pairs that the dollar comes as the second currency pair, and when the dollar is weakening, they go up, while when the dollar is strengthening, they go down. For the currency pair where the USD comes first, when the dollar is increasing in value, they are actually going to be going up. Okay? They are going to be going up. While if the dollar is weakening in value, they are actually going to be going down. Okay? Just keep this at the back of your mind, okay? So you can see this is also the daily time frame of the USD Canadian dollar. And when we go to around February, when we had that shift in the market structure of the dollar index, where the dollar went from being super bullish, super strong, to now, switching its direction, to now moving in the direction of a downtrending market, you can see that the same thing happened on this particular currency pair. It was kind of like a warning signal. And we saw that immediately after the switch of the market structure on the dollar index, you can see that the dollar went from being strong and making higher highs and higher lows to now struggling to even retest its previous highs. And then it switched from forming the market structure of an uptrending market to, after a slight bit of consolidation, to now breaking below the consolidation zone and now forming the market structure of a downtrending market, which is lower lows, lower highs, lower lows, lower highs, lower lows, and lower highs. So just from paying close attention to the dollar index chart alone, we've been able to identify reversal or turning points or low risk high probability trade setups on almost around 4 currency pairs. That I've shown you 3, and I'm going to show you the 4th one now. But we've been able to identify a ton of reversal in currency pairs across the board. Okay, so does this mean that every single time you see that the dollar index is going up, dollar currency pairs are going to be going down or whatever? That's the ones that have the dollar as the second currency pair, while the ones that have the dollar as the first are going to be going up. Not every single time, but in trading, this is where edge comes into play, because we don't need to happen 100% of the time. We don't need this to happen 100% of the time to be able to exploit it and make money. What we just need to do is, for as many times as it does this, we're going to take advantage of it by taking trades where we're risking a small portion of our trading accounts, and then going for at least 2 times what we're risking on the trade, or maybe 1.5 times. It doesn't really matter, okay? But just make sure that you're aiming to make a profit which is at least bigger than what you're losing. This is especially important when the particular trade setup that you're trading with has a low win rate. Its win rate is not around the 70, 80, 90% or whatever. Okay, and you don't even need to have that kind of win rate. Like I keep telling you guys, most of the time, the trading strategies I use, their win rates are around 40 something percent. But because my average profit is way larger than my average loss, I still end up making profits in the long run, okay? So even if this was just to happen, this coincidence, this correlation was to happen just 50% of the time, okay? And you were to position yourself properly, with proper risk management, with consistent risk. Meaning, if you're risking 1% of your trading account's capital per trade, you're always going to be risking 1%, nothing more, nothing less. And you're aiming for a risk to reward ratio of maybe 1:2 or 1:3 minimum, okay? Eventually, even if you, let's say after taking like 100 trades, even if you lost 50 or 60 trades, those 40 trades that you would have made profits from, or those whatever number of trades you would have made profits from, because their average profit is way bigger than their average loss, you're still going to end up being profitable in the long run. Now, let's look at another currency pair, the USD CHF. The same thing happened. And you can see that the volatility on this pair was just insane, because in fact, in all of the charts that we've studied, I don't think I've seen anyone that's been as clean as this. Okay, so again, just because I want you to see the power in this, let's go back to here, the DXY. Okay, so let's search for the DXY. Again, you can see that this is when the market structure shifted, reversed. Okay, around February, right? Now, when we go back to this chart, the USD CHF, and place a horizontal line around February, you can see that exactly the same thing happened here. So we went from forming the market structure, that because it was going up, because the DXY was also showing us that the dollar was strong. So when it was strong, it was forming higher highs and higher lows. Higher highs, higher lows, okay? But then when we had the switch in the dollar index, you can see that we also had a switch in the USD CHF. So it went from forming higher highs and higher lows to now finding it difficult to continue forming higher highs and higher lows, but then breaking the market structure of the uptrending market and switching to a market structure of a downtrending market, which is now lower lows and lower highs. And you can see that this setup was just so clean, because after this switch, price just moved down so quickly on this particular currency pair. Okay, so just think about it. When you're using the dollar index in the way I've shown you how to use it now, you're not even going to be restricted to trading only one currency pair. You can trade a ton of currency pairs where you have the United States dollar as either the first currency or the second currency. But I also want to give you a warning note here, because most traders, when they learn things like this, they start going haywire. They just look at the chart of the DXY and they go, you know what, the DXY is going up. I'm going to every currency pair that has the United States dollar as either the first or the second currency. I'm going to go and trade it. This is where you're going to be doing yourself a disservice. The reason is because of something known as correlation. Okay, so when you buy the GBP USD currency pair, for example, and then you sell the United States dollar against the CHF currency pair, you're basically, if you're risking 1% on of your trading account on each one of these trades, you're basically risking 2% of your account's capital on the United States dollar. And the reason is because you are exposing yourself to the United States dollar in both of the trades that you took. So if you bought the GBP USD and you sold the USD CHF, it's almost like doing the same thing, because in both of these scenarios, you are shorting against the United States dollar. Okay, so even if you want to use the dollar index strategy, like the way I showed you here, so that you'd see what it's doing and then look for signs on currency pairs that either have the dollar as the base or the code currency, you also still want to be very cautious, trading with proper risk management. Okay, so that you don't just go haywire and risk your entire capital on all of those trades. And you know how they say it. Okay, so basically this is how you're going to be using the dollar index. Okay, you identify what it's doing, preferably on the higher time frames, because the lower time frames would have a lot of noise. Okay, and basically if you're not a day trader or a scalper, you're not going to need to look at the dollar index on the lower time frames. Okay, so ideally this kind of trading methodology works much better for traders who are swing traders. Okay, so you're going to look at the maybe time frames like the daily time frame or the 4-hour time frame or maybe even the weekly time frame and see what the dollar index is doing. And then once you have an idea of what the dollar index is doing or what it's likely going to do, then you're going to be looking at other currency pairs which have the dollar as either the base or the quote currency to identify trade setups which align with what you saw on the dollar index chart. Okay, and then you trade that with proper risk management, the right mindset, and all of those things we keep talking about that you need to do for profitable trading. Okay, so this pretty much brings us to the end of this week's edition of the class, and I really hope you got value in it, because this is one of the tricks that a lot of traders don't know. Okay, except the pros who have been doing this for some time, because most of the times traders just think, I just need to learn SMC or, just learn moving averages or any of those strategies. And they just focus on one currency pair, which is not a bad thing to do. If you've got an edge and you've tested it and you've seen that it performs well on that currency pair, do you focus on that one currency pair? But you're not going to just remain stuck with one particular trading methodology or whatever the case might be. You want to improve consistently. Okay, so if you're looking to improve or you're looking to add to your arsenal, improve your trading skills or add upon what you can do, the currencies you're trading or whatever the case might be, to improve your results and improve your profits, then you can want to learn one of this and then focus on testing it, refining your edge and perfecting it. Okay, so try this out. Use a simulation software, okay, and see how price reacted, the price of the DXY, how it reacted, and how currency pairs which have the dollar as the first or second currency also reacted in response to that. Okay, and this is going to give you another edge you can add to your trading toolbox and exploit for as much as you can. But before we wrap up the class, I would like to use this opportunity again to let you guys know about our tools which are going to help you to earn while you're learning. Okay, which is our ITU bots, which are basically designed to identify low risk, high probability trade setups for you, and then place those trades for you while you're even away from the charts. Okay, with the setups on the platforms, on the VPS, they're going to place the trades for you, do everything, manage the trades, exit the trades, everything, without you even having to lift a finger after you've done the initial setup and everything. So if you're interested, please reach out to us on our socials and we'll be more than happy to assist you step by step, set everything up and give you the guides, okay, to follow and set everything up to start earning while you're learning. Okay, so once again, thank you for taking time out of your busy schedules to attend this class, and I look forward to seeing you guys in next week's edition of the class. Have a wonderful rest of your trading week, and God bless you all. Cheers. Go out there and practice it and perfect it, and before you know it, you're going to have multiple ways of exploiting this particular market for profits and cash and everything. Okay, so once again, thank you and God bless you all. Have a wonderful rest of your week. Cheers.